Good morning. Good afternoon to everybody in Europe. I am Mark Sebastian, your only option, and this is Option Pit Live. We are here with you live every Friday at 9 a.m. Eastern Time to hit on all the important topics that are affecting the market and get you ready for the last trading day of the week. I will be joined shortly by one Imperial Overlord of Income, that is Hans J. Albrecht, and of course, Andrew T for Too Much Fun. Giovinazzi will be joining us as well. But let's get this show rolling by talking about the news of the day. And that, of course, is non-farm payrolls. They come in and adjusted 151,000 for the month. That is less than the consensus, which was somewhere between 160 and 170, but it's not like it's horribly bad. January was revised down a little bit to 125,000. But still nothing absolutely crazy. For those of you keeping Doge score, the federal government employment declined by about 10,000 people in February, though government payrolls overall increased by 11,000, the BLS said. So the federal government sheds it, your local government picks them up. And the more other piece people watch closely is wage growth, because that directly reflects on inflation. Average hourly earnings increased by 0.3%. That is what we were expecting. The year over year was actually a little bit soft. Markets were looking for 4.2%. We got 4%. So what are we getting out of the markets on this? Down a little bit, flattish. Nothing really nuts. As I'm discussing this, the triple Q is down about 10 cents. Good for flat. S&P SPY is down about 0.6%. Diamonds, which are the Dow Jones, down about 0.3%. And the Russell 2000, ye old small cap, actually up 13 basis points, so 27 cents. Nothing. So not a huge reaction after Thursday's losses. Thursday's losses came as a result of continued fear, you name it. So what I want to just real briefly talk about around this is that today's going to be kind of twofold, right? The market looking to unpack what happened over the last 12 hours and over the last 12 hours, well, we'll call it 16 hours. Since then, we've seen Broadcom earnings come out, and Broadcom is the 7th largest company in the S&P. We've seen those earnings come out, and then we've had this non-farm. Non-farm does not seem to be affecting things, but if you want to know why the Qs seem relatively strong, your answer is Broadcom. Closed Thursday, $179. It's currently trading $196. Market was pricing in about an 8.4% move on their earnings. They're currently moving just under 10. So you're getting a serious outperformance to the bull side for Broadcom. Coming out of this earnings, looking at Broadcom, I think there is going to be some opportunity. I'm going to be looking at it in Delta Strike, which is my trading service where I follow big money flow to see what they're doing. So my approach to trading is let the really, really smart money, the guys that have 100 people working for them, figure out what options I want to buy and then trade with them. Normally it seems really easy, except when you get a sell-off like this, calls outpace puts in the market about 1.5 to 1. And so when you get a market sell-off like this, and what happens is the market starts to correlate. What does that mean? What that means is everything kind of tends to move together a little bit. Now, this sell-off, there's been some areas of separation, but when the whole market kind of just looking at the S&P, if you look at what it's done since the 20th, right on the 19th, it tops out 61.44. We've fallen over 400 points. When you do that in a very short period of time, it can be a problem because a lot of call buyers expect the market to be normal, right? You'll have your up days, you'll have your down days. Stocks aren't as correlated as we think, and this stock outperforms even if the market is flattish. But when you're dropping 1%, 2%, 3% a day, even when you're right, you can be wrong because the market can pull you down, which has happened to a lot of the call buys I've seen. So what do you do? Well, in Delta Strike, we've done two very important things. All right. One, when we saw that the market might fall apart, we executed a portfolio hedge. How do you do something like that? It's very easy. I used SQQ. I bought the SQQ for today, expiring today. I bought the SQQ 33 calls. We made well over 100% on those. Was a nice win. Paid $1. All right, now, what else can you do? This is where understanding your portfolio and what your exposure looks like is so important. When I look at my portfolio in Delta Strike, generally speaking, it's going to be shaped like call and put flow. So if I've got 10 trades on, 6 to 7 will be calls, 3 to 4 will be puts. And having those puts is important because when the market does correlate and everything drops, you can make more on 3 puts with the market dropping 400 points than you lose on 6 or 7 calls because those puts can make you so much money. An alternative is you can use market internals to set up long and shorts with paper. So for instance, on Tuesday was an ugly day. If you want to show my screen here, Tuesday was kind of an ugly day, right? We had Monday, we had Tuesday, and then Wednesday was kind of the bullish day. So what did we do on Tuesday? Well, look at the price action of Apple. It did not, unlike, let's say, a Tesla or a Meta, right? Look at Meta. It walked on water and then it has just taken a dive, right? Apple has not done that. Why? Apple is a safe haven asset. This is something we've explained a couple of times. Apple is where the money goes to hide. So on a day where if the market goes up, Apple is going to underperform when we've been selling off. Let me repeat that. If we're in the midst of a big sell-off and we get a bounce rally, Apple is going to underperform and might even be down. This is what we saw on that Tuesday when Apple on that Wednesday after my Tuesday trade when I bought puts in Apple and Apple absolutely tanked. Bought our puts for like $3.50 and we're selling them at some traders got over $7 the next day. At the same time, you have a stock that has really underperformed the other Mag 7s, a name like Amazon. What do? We buy calls in Amazon at the same time. Those are about $4.40. We sold those at over $7 as well. Next thing you know, I've got a put in Apple that made me 83%. I have a call in Amazon that made me about 75%. So balancing that portfolio, this is something we do in Delta Strike. Balancing that portfolio is what is going to save you when the market starts trading as one, when everything is correlated. All right. Speaking of the one, let's to talk more about it from an income trader perspective, right? A lot of people have covered calls, a lot of people are selling puts, a lot of people have wheel positions, or a lot of different approaches to creating income using options. To discuss what to do in a stressed market around income is our very own imperial overlord of income, the future governor of Canada. He is Hans J. Albrecht. Hans, welcome.
I love it. I love the intro. Thank you, Mark. Morning, everybody. Yeah. So, of course, as I prepare for my governor role as the 51st state, I am still focused on markets because there is some pain, right? So this Trump put that everyone sort of felt that was there after the election, we've really seen a 180. So that's been part of the problem out there in markets, is we've really seen a complete sort of shifting of narrative. President Trump has not been supportive, and he hasn't really been too secretive about that. He and Besson have said, listen, we want things to change. So we have to trade what's in front of us, right? So that is the issue. We sort of the investors, are now starting to look at markets and say, well, where is the light at the end of the tunnel? And they've been realizing that it's a bit more of the light from an oncoming train at this point. So we're hoping that at some point that shifts to light at the end of the tunnel. We've seen skew really pumping. So as an income trader, I'm looking at overall option pricing. I'm looking at skew levels. How aggressive are people buying protection? And we've seen that they're quite aggressive lately, which I think is a positive, because people who own stocks and have hedges are more prone to hold on to their stocks, right? So we have the VIX has certainly run up a little bit, but it has not gotten out of control, as we saw sort of in August and September, et cetera. So people are loading up on hedges. I think that could sort of point to some potential support here down around this 200-day on the S&P. I think fundamentally, things are developing into a bit of an issue overall. Where are earnings going to be? Analysts are sort of looking at this going, well, I don't know. And certainly CEOs and outlooks are going to be kind of up in the air, given what's going on out there. So people are getting a little bit paralyzed. So I think we have to kind of keep in mind that backdrop of the bigger picture being injured a little bit here. And we see that as business confidence, consumer confidence falls down. So as an income trader, we have to kind of divide our focus a little bit. We have got the usual suspects. We're looking at the AVGOs, the NVIDIAs, the sort of higher beta world of growth. And I would say it's difficult to pick a bottom in those. We are seeing a more elevated option pricing. You can look at things like cash secured puts. If you own some of these names, you definitely could be looking at some cover calls as a way to sort of generate a little bit of a hedge, a little bit of income, lower the volatility in your portfolio a little bit. But it's difficult trying to pick the bottom in that area. So if you want to focus, in my view, on those sort of usual suspect type areas, I don't think it's wrong. I think at some point, maybe these huge balance sheet companies become almost a little bit defensive in nature, even if times get tough, right? People are going to run into the Apples and some of these other companies. But be very, very careful. Pick your spots. And in the world of tech, I'm kind of thinking a little bit more, think of moats. Think of companies like Netflix, Costco. We're seeing Costco pull back to that breakout from early February, Mark. I don't know if you noticed that, but it's not a cheap stock. But you have to almost think about difficult times. People aren't going to get rid of their Netflix plans. They're not going to get rid of their Costco memberships. We've seen incredible loyalty there. So I'm looking at some areas like that look interesting. Amazon, of course, which you talk about a lot. Shopify, people starting businesses. So I don't think tech is out of the picture, and things like Costco look interesting. But my focus is also, as an income trader, you really want to look at quality. You want to look at overall trends, of course. The market is the market, and you can't ignore that. But I'm starting to look a little bit more in areas of stability. So don't be afraid to look around, right? So after a couple of years of very high concentration in a few stocks that have really propelled the market higher, at least till about 4 or 5 months ago, we've seen some broadening out. I'm interested in areas that a little lower vol, a little bit more stable, a little bit kind of solid sort of fundamental backdrop in a more difficult environment. A P&G, a Walmart. Healthcare looks interesting. Medtronic devices, healthcare devices. Novo Nordisk. People still want to be skinny, right? That's going to be the case. It's expensive, but people want to be skinny. You can never be too. What is it? You can never be too thin. You can never be too rich. Something like that. So.
Right. Or if you want to quote Claudia Schiffer, you could say nothing tastes as good as being thin.
That's right. Just don't eat, right? That's what they said in Canada. Look, if you're struggling with inflation, just don't buy food, and
it worked out great
fine.
for Karen Carpenter.
Yeah, I was like, wow, what a great idea. Just don't eat. You can really cut down on your grocery bill. We get really great advice up here sometimes. So some of those areas, and I think ultimately, even though things like IWM, the Russell has sort of struggled a little bit, I think eventually, I think oil just tanks. I think rates are going to come down. So I think some of those areas look a little bit interesting. So cash secured puts can be very, very useful. I've been doing some of that, of course. And I think in a higher volatility environment, you want to look at put credit. So these are things that we're going to really focus on in my income product that is going to be launching very, very soon. In a high vol environment, what do you want? It's okay monetizing sentiment and fear and worry, because that tends to be an okay thing to do over time if you're tactical, if you're strategic about it. But at the same time, in a higher volatility environment, you want to own a little piece of leverage. So that those put credit spreads can give you that little extra bit of gamma, at the risk of using, the scary Greek words. A little bit of gamma can help as things move around. And so I've had a trade on Meta that's like that. We had a put vertical, and I've been able to monetize that long put. So very interesting things you can do, but you have to really shift. This is very much a different environment. You need to have a little bit of protection, just as Mark was talking about here. You have to have a balanced portfolio, and that goes for income trading as well. So hopefully that gives you a little bit of an idea of how I see things right now.
Yeah, I think I love your idea to pivot to some maybe more boring names. I was looking at 3M, and I was noticing that you're getting with a stock that's relatively pretty stable, unless they're going to have another what are they? The earplug issue. I don't see a major sell-off there. The April 140, 130 put spread nets you more than $2. Approximately 4% out of the 4 or 5% of the money, depending on what 3M is doing. And frankly, anywhere 138, I want to be long 3M anyway. So like Hans, we can't wait. Now you're in the midst of a special situation, but you have a major product launch coming. Everybody needs to be prepared for that. I believe that's coming at the end of this month, correct?
It is. And look, I'm going to infuse this product with almost 3 decades of having done this. I've managed almost $1 billion in options overlay strategies, and income strategies, and downside protect strategies. We are going to put this all into this product so that we can be option harvesters for income and cash flow, but smarter. The market's going to do what the market does, and we need to be able to pivot. And that's what pros do. You take what's in front of you. You don't trade on hope. You take what's in front of you. You trade the reality. And that's what we do every day at Option Pit. And I'm really thrilled to be a big part of this with this new product coming. It's going to be really exciting. And I'm looking forward to it.
Me too. Hans, thanks for swinging by. Let's say good morning and good day to you, Hans. And let's bring in our own Viking of Volatility, Andrew T. for Too Much Fun, Giovinazzi. Andrew, good to see you.
Thank you. It's a pleasure to be here.
All right, Andrew. So here we are. And, I wanted to talk about how two-way trades have done during this market, because this is kind of the market that two-way trades are sometimes seem like they're designed for. Now, for those of you that don't know what two-way trades are, they're associated with Andrew's weekly profit cycles. Why don't you give us a brief on what are two-way trades?
Yeah, to start with, it is basically you want a long market piece and a short market piece, and meaning, you got a bullish piece and a bearish piece. However, with weekly profit cycles, one of those pieces will be a volatility product, VIX. So it'll be a position in VIX, either long or short, that takes advantage of the VIX curve as it stands. So I have an example of one right as we speak, actually. So
all right.
This is what I would call, this is like the rip trade. So when the VIX curve is backward like it is right now, let me see here. I don't know if Lewis can show my screen, but normally when you see this here, let's see what we got. You get kind of this thing here where VIX is way up here and the futures are way down there. It's been a while since we've seen this, right? Mid-December.
Yes.
So basically what this means is saying, like, the market is, as Mark would say, bananas, I believe is a good way to say it. And real quickly here, what I do is I like buying in the money call spreads in VIX and then being long SPY for a rip against it. That's this in this particular scenario, because the market could rip 100 points SPY or 10 points SPY. We trade SPY in here, and VIX could not really do a whole lot. Might be down a little bit, but sometimes the rips are so extreme when vol's this high. So it gives you a chance to play the rip, and then, or if we maintain this vol cycle, your VIX call spreads will pay. So right now, the call spread I chose was the 2030, which is, if we stay in this regime, this vol regime for some period of time, your VIX call spread will eventually pay for the whole trade. So if you don't get a rip that you can't close, the market just goes ugly for the next week or 2 weeks, you have an exitable trade, and then you move on to the next thing. So the whole idea of the two-way trade is to have a part on that will eventually pay you, market going up or down. You close the pieces that pay, and then you move along to the next week. That's why it's weekly profit cycles.
Exactly. And obviously weekly profit cycles is kind of designed to weather a market like this.
Yep.
It's specifically designed to maybe not over wow you in a bull market, but still do well. But when the market rolls over, that is when you get wowed by how much you outperform the overall market. And in the event of a major correction, you do have an embedded, like a major overnight gap. So we wake up down 6-7%. The strategy absolutely cleans up. So how have things looked over during this?
Good. We've had plenty of we've had plenty of SPY put spreads to close, and we're sitting on some VIX puts waiting for vol to drop in April. So in March and April. So it looks good. It's exciting, and I'm waiting for the market to move today. Just do something.
Yeah, I'll be interested to see if it does. Certainly is acting. I mean, going into yesterday, they were pricing at about $100 move, and currently we're getting $8.
$1.
Yeah. It is not the most exciting morning. So, weekly profit cycles, keep on the lookout. We're going to have a special offer for weekly profit cycles heading your way next week. So if you are not a member of weekly profit cycles, let me tell you, this is the market to join it in. If you want to kind of like a set it and forget it trade that you put on once a week and forget about and let perform. Speaking of letting perform, Andrew, you're also heavily involved in what I think is the perfect product for this market.
This is true.
And what we have a service called Capital Gains, and it's spelled like state capital, our nation's capital, not money capital. And that's because our own K Street to Wall Street guy, Frank Gregory, uses all of his insider connections and his understanding of public policy. The man worked on Wall Street. The man worked in Washington for years and years and years. So the ability to understand policy and have the insider connections on who is winning and who is not winning gives us a real advantage. To discuss that, let's bring on Frank Gregory, our own one chief legal counsel for Option Pit, but also our expert on K Street and Wall Street. Frank, good to see you. Obviously, we've got a lot of balls up in the air. What was your reaction? What is your reaction to what has happened the last couple of days? And then I'd like the two of you to discuss how you've attacked the Trump policies to create profits over the last couple of weeks.
Sure. Hey, well, thank you for having me. A, B, never mix expert and lawyer in the same sentence, but that's a whole different story. Look, I think we're seeing a lot of, it's a weird combination right now of, a little bit of the Trump, hangover setting in, but also, the speech that he gave the other night reinvigorated some things, but also really showed that he is using geopolitics as leverage. And he's got a couple of goals, right? He wants the world to pay for more stuff. He wants our infrastructure in the U.S., particularly when it comes to mining and other critical necessities like chips, to be built up here. And he is putting pressure through tariffs or threats of tariffs. I mean, look, tariffs come on, tariffs come off, tariffs come on, tariffs come off. Oh, there's an exception to tariffs. So, this is all just gamesmanship going on. However, it's playing nicely into some of the themes that Andrew and I have been discussing. We are, and China is reacting as if all of this is real. Yes, Mexico and Canada, love you, Hans. You're having your little shots you're taking, but in the end, that's just some cross-border politics. China, though, is taking this seriously. They are cutting off critical mineral supplies. They are really engaging in this trade war full on. We can take advantage of that in our portfolio because there's very limited opportunities for investment in current mining, for instance. MP Materials, we've done a really good job watching that, playing these moves to make some money in that stock. On the defense side, you're seeing really big names make some money, as well as some small names, but not all big names are equal, right? So, the speech the other night, you'd think every defense stock would pop, but Lockheed Martin, they got a little shot because they got shot down for the new fighter jet. That's going to be a huge potential hit from them. They're not even bidding for it. So we are watching the right defense names. We're watching certain critical mining names. And by the way, there's a new mining one that's about to go public in the next couple of weeks. So more to come on that. We're keeping an eye on that up front. But we're looking for building up of America's infrastructure for critical minerals and defense. Those are the two big themes we have going on. And a little side note, chips, because chips tie into both of that.
Yeah, Andrew, you guys have had a couple of nice trades the last couple of days around this, right?
Exactly. We've been long mineral stocks, MP, which could be a huge winner after the this whatever Ukraine deal holds out, because we're going to need that technology to go grab stuff out of.
And by the way, that Ukraine deal's a nothing burger. So let's just put that
up 50% since the beginning of the year. Huge run in MP. Great catch, guys. Any other names that you've had nice success with?
Sorry, go ahead, Andrew.
We're looking at Taiwan Semiconductor. We have a long Taiwan Semiconductor, short NVIDIA. That's worked pretty well. Taking a little page out of your playbook. And these are all what we call zero theta trades. So when we put the trades together, there's no actual decay in the position. So it's a little bit of option magic and a little bit of Frank wisdom connected together to put these trades together.
Absolutely. And I got to tell you, I think the next couple of days, the next week or two, I think the whole firm is basically, I know the whole firm is relying on Frank's insight. Every morning we have a company-wide meeting with the traders, everybody that works at option, but we meet every morning. We're going to meet right after this. And part of that meeting is the traders kind of powwowing about what we're seeing in the markets, how we want to address this. We have been relying on Frank so much over the last couple of weeks just to kind of explain different policy pieces as they come out, because I feel like I feel like I'm playing Beat Saber with all the policy changes that are coming out. Like it's like a game of Guitar Hero trying to navigate all the different things coming at you. And Frank's been our resource. So if you'd like to take advantage of that resource, we've got a special for you for capital gains. Pick up the phone, call Ted and Drew and Zach. The number is 888-872-3301. Tell them you want to join capital gains and that you watched the show this morning, and they will have a special price for you and a special opportunity for you to join. If you're not a member of capital gains, today is the day to change that. Again, pick up the phone, give us a call, 888-872-3301. The market is open. We're currently down $10 in the SPX. The Qs are down 0.1%. The Dow about 0.3%. Frank, I'm going to give you a pass on predicting. You're our thematic guy, not our day trader guy. So I'm going to give you a free pass here unless you want to jump in. Andrew, what are you thinking for the rest of the day?
I don't know. I think we're going to digest. It's weird. It's a very odd opening. We're not opening down big. So I think the market will take another breather and SPX will be up. I know it sounds crazy, but somewhere 75 to 100 points would be my guess. I think we erased a lot.
Oh, you're looking for a big move here.
Yep. Well, VIX is 25.
We did gap below the 200-day moving average. 200-day moving average is now 57.32, going up about 3 points every day. So believe it or not, dropping $5. Yesterday we closed above the 200. The $5 drop gets us back below it because the 200 went up a little bit and the S&P is down a little bit.
Yeah, Mark, look, the rhetoric from the last few days has toned down politically, but there's still a lot of uncertainty in the world. And you know how the market loves that. So.
They do. Well, all right, here's what I'll tell you. What happens between now and 12 and 1:30 p.m. this afternoon is almost completely uncorrelated to what's going to happen between 1:30 and 4. So I'm going to give you two things. We're going to rally till about 1:30, and then some decisions will be made. That is when maybe we'll be up 30 or 40 points. That is when we either drop and close the day down 50 to 100, or we make a serious run and try and take out the highs from Thursday. There you have it. All right, folks. Thank you for joining us. I hope you guys have an incredible Friday and a great weekend. So for Frank Gregory, our man on the street. All right, the likable lawyer, Frank Gregory, other things that don't go together. And, of course, our Viking of volatility, the Vicar of the VIX, Andrew T. Giovinazzi. I am Mark Sebastian, your only option. This was Option Pit Live.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.